You've got to know how to read the market. You've got to learn what the market is telling you. And starting with the big picture, you've got to see what the market is saying and know what the trade opportunities are going to be before the market actually presents them to you. Now, here's the price action on Thursday, June 6th. Market essentially went nowhere, right? Here's the market on Friday, June 7th. Tremendous price movement, right? What's the difference in the trend between these 2 days? Absolutely nothing. And here's why. I'm going to take you to my calculations, and I use numbers to gauge the market. Here's Thursday, June 6th, and I just want to concentrate on these 4 columns: open, high, low, and close. And on Thursday, June 6th, the open was at 53.69 and the close was 53.65. Basically a 4-point drop. Basically 4 points is nothing. So the market went nowhere on Thursday, June 6th. Now here's Friday, June 7th. Market opened at 53.52 and closed at 53.56. Went up 4 points for the day. So went down 4 points for the day on Thursday, went up 4 points for the day on Friday. The market essentially went nowhere. However, looking at the market price action for each of those 2 days, dramatically different. The price is dramatically different. Little amount of movement on Thursday, high amount of movement and energy on Friday. So that's the big picture. And you need to know the big picture before studying the little picture. Now on the little picture, and that's where you trade, the daily trading chart is between the hours of 9:30 right over here and 1600 or 9:30 a.m. and 4 p.m. So here on Friday, the market opened right here at 53.52, closed over here at 53.56. Not much movement, but lots of movement during those trading hours. So what is the trade? What's the trade for Friday? What's the trade for Thursday? And the trade is almost exactly the same. And if you don't know what that trade is, you're not going to know how to trade these charts, these markets. Now, the trade was the same on Thursday and Friday. Where's the market going? Now, that's something else. During the day, where the market is going, I use certain signals. The chief among them is the Taylor trading zone, which tells me where the market is likely to go before it even gets there. And I draw the trading zone on the chart prior to the market open. And if you've seen my previous videos, you know I tell you that the absolute low and high, the calculated low and high support and resistance, often requires transposing in order to see the big picture of where the market is going to go for the day. And so when I clone the trading zone, clone it to the intraday low, which was right over here, okay? I'm going to clone it to the intraday low, which was put in. And remember, the intraday high and low generally going to be put in before the first hour of the trading day. And so the intraday low was right over here at 53.41. And so the transposed forecast for the market was to go up to 53.77, 53.78. And that's exactly where the market went. And so if you use this parameter, the Taylor trading zone, you know where the market is likely to go. Not that it will go, likely to go. But there are other setups here. There's the gap trade, which is a trade that every trader should have in their quiver, because the gap trade is a basic trade. If you learn no other trade, you need to learn the gap trade. Now you also need to learn psychology. Trader psychology is so important because in hindsight, look at this chart. Look at all the opportunities this chart is offering. No, it doesn't, because this is a scary chart. Because look, the chart goes up and then drops precipitously. There's no indication the market is going to drop here. Of course, there was a pre-market high we put in, but there's no indication that the market is going to drop down there, especially if you don't have the Taylor calculator, because if you had the Taylor calculator, you knew that if the market did reach this point, which was the transposed point, you'd get out. You'd get out and be thankful for your profit, okay? And forget about the rest of the day. Here's another aspect of the day where the market traded up to 53.80, precipitous and fast drop. So is that an opportunity? Could you see it beforehand? You couldn't. So these are trades you need to stay away from. Don't be lulled into thinking that the market is easy or you can make a lot of money based on the fact that hindsight shows you, look at all this movement. You certainly wouldn't take that attitude on looking at Thursday's chart because the market really didn't go too much. But it offered the same opportunity. What was that opportunity? A gap trade. The gap trade was the same opportunity. Not as much as on Friday, because on Friday, the price opened well below the gap. The gap was over here. On Thursday, the market opened right about over here, traded up, but then hit a plateau, went down to the gap to fill the gap. Now, actually, these are the same trades showing 2 different days, 2 dramatic different price actions for the day, but it was the same trade. So if you're going to learn to trade, you need to know all the aspects of trading and what not to trade, what to stay away from. That's why I teach the 6 trade setups in my trading course: GST, TMC, gap, support and resistance, trend, time and price, momentum, and candlestick. There are only 6 trade setups, and if you don't see it, you shouldn't be trading. Then there's rules. Rules keep you safe. I suggest 12 in my course. There are 6 that are critical. You need to know these rules because rules keep you safe. Of course, the mechanics, stochastics, intraday high or low, the Taylor trading zone, these are mechanical aspects of trading that you need to know about to help you trade. So that's my video today. Marv Eisen from Timeless Dollar Trading Academy. Trade safely, use lots of patience. Thanks so much for watching, and I'll see you in my next video.